Hi there. Thanks for tuning in. Today we're going to do an analysis and valuation of SiriusXM Holdings, ticker symbol SIRI. Let's go. So SiriusXM, if you have a car and you're in the US, you've probably heard of them. They're essentially an audio streaming service. SiriusXM works with radio, Pandora, and Stitcher, may work with other stuff as well. They have 150 million total listeners, they have 40 million paid subscribers, and 153 million of basically auto fleets where SiriusXM is enabled, vehicles where it's enabled. So that's mainly their source of revenue, is from being there in vehicles and people pay to get this service, right? And in their growth priorities is this in-car, growing their streaming service, growing their ad platform, and also putting it everywhere. They have images of an Xbox and a PlayStation here, and an Amazon Alexa or Google, whatever that device is called. So they do want to be everywhere, but still the cars are going to be their main platform. And they have had actually a fair bit of subscriber growth. It's interesting because radio is seen as sort of this dying breed, but at the same time, they're more of an audio streaming company rather than a radio company. So they have had a healthy amount of subscriber growth. They have had significant amount of subscribers added between 2019 and 2022. And this overall seems to be a good story so far. So here even, we see that revenue has grown very consistently, EBITDA as well, and free cash flow. Free cash flow has stayed pretty steady, but I like when companies show this in their investor presentations, which is where these slides are coming from, because it shows that they at least care about the hard cash that they're generating, the cash that they have to work with. So they also have pretty good capital returns. They give back dividends and they buy back shares. They have done this every single year, and they do commit literally a couple $1 billion each year to do this, right? To increase their dividend or to pay dividends. They have paid a special dividend recently, which is basically the first one they've ever paid, and buying back shares as well. So that's good to see so far. However, now we're seeing that a lot of these streaming companies depend on how subscribers grow over time or how they decline. And we'll see that in the SiriusXM platform from 2021 to 2022, they did have a little bit of subscriber growth overall, right? Both in the US and Canada. However, in Pandora and off-platform, which is all their other services, they actually had a very significant decline in subscribers, right? So subscribers are in thousands. So even though they saw an increase by 272,000 subscribers, they saw a decrease of who even knows here, monthly active users. So this would be 4 million subscribers, right? That's crazy. That's a significant chunk of people leaving the platform. So this should be reflected in the revenue, and this also affects their projections. This also affects how people like the stock, because at the end of the day, all of these stocks that have to do with streaming services are based a little bit, their price is based on how much investors want them based on these promises of growth. And if they're not delivering the subscriber growth, which would drive, in theory, the revenue growth and the profit growth, then investors are going to shy away from it. So that's interesting, and that's something to note. There's also the fact that they actually run pretty low costs for their services and for their income. So actually from their revenue, operating expenses, sure, there's a healthy chunk taken out, but their operating margins are decently high. It makes sense. It costs them very little to sell an extra subscription besides marketing. But yeah, they do have some infrastructure like satellite infrastructure or some radio infrastructure across the United States and Canada. But besides that, their operating margins are decently high, are in the double digits, and so are their net income margins, as we'll see. And their free cash flow is also decently healthy. We'll see that the free cash flow in 2021 actually has some additions from satellite insurance recovery. So in my own calculation, I'm going to take that away. But yeah, they do have some nice free cash flow right there. And to calculate free cash flow, I'm basically going to compare it to net income and then take out a ratio here. You'll see that 2020 was a very difficult year. So I'm not going to count this. Their net income, of course, it went down. People weren't taking their cars out in 2020. So this ratio of net income to free cash flow or free cash flow to net income skyrocketed. I'm going to take this out because it's an obvious outlier. And I'm going to take this 180% out as well in 2019. And then we're left with these three really similar numbers. So I'm just going to call it 125%, which let's call it a rough average between these numbers. So I'm going to say 125% of net income is going to be turned to free cash flow. And which makes sense because free cash flow is net income. And then you add a few items like depreciation, amortization, stock-based compensation, etc. So that makes sense. I think that's a pretty decent conservative calculation to make for the future, and it's in line with their numbers. However, I'm going to point out their debt. This is a screenshot from Seeking Alpha, where we see they've been issuing a ton of debt here. Look at that. They've been issuing here in the total debt issued billions of dollars in debt, and they have been paying off also billions of dollars in debt, but never as much as they've been issuing. They always issue a ton of debt, and they always pay off a little bit less, which means that their debt pile is going to be growing. And the lack of assets here is crazy. Look at how much cash they have in millions. They have 57 million in cash as of December 31st, 2022. Compare this to the debt that they issue. Even here, the difference here is of about $250-300 million for December 2021. For December 2022, it's $573 million in debt that they issued. That's crazy. That is absolutely crazy compared to this $57 million in cash that they have. They're not really paying off. They don't really have enough cash to pay off the debt if need be, right? Sure, the amount of revenue that they make is probably enough to pay their interest expenses, for example, just fine. They make $9 billion in a year. That's more than enough to pay any interest expense you may have. But the fact that they don't have any cash on hand is a little risky. And the fact that all of their assets are made up mainly of intangible assets, intangible, we can't get a sense for it, and goodwill, which is essentially showing that they overpaid for acquisitions, and if they want to reduce that goodwill, they have to take a loss in their net income, or they have to subtract that from the net income eventually. Well, this shows that their assets are mainly in things we don't really want. So they have a lot of liabilities with the debt, and they don't have a lot of assets. So that's a risk in the balance sheet that we have to take into account. Now, I'm going to pass these free cash flow values that I talked about before in a discounted cash flow model using free cash flow to equity. I'm going to give it a required rate of return of 11% and a perpetual growth rate of 2%, right? And I've took from Yahoo Finance analyst predictions, which essentially forecasted about flat revenue growth for 2023, a little bit of growth for 2024, and then I'm just growing it at 2% from 2025 to perpetuity, right? And based on this, and that is also with a net income ratio of 125% of free cash flow to net income, right? So with these numbers, plugging them all in and dividing it by the number of shares outstanding, I get a fair value of $4.23. However, we just talked about the debt, and we have to add that to the calculation, right? So when we subtract the total amount of debt, which is almost $10 billion, to the fair value we actually get with debt included, with an 11% required rate of return and an 11% yearly rate of return that we want, and a 2% perpetual growth rate, is $1.69 with net debt included. That is a huge delta between the value before and after the debt. And that's important to note, right? So where's the stock price now? Well, you'll see if you held SiriusXM for the last 5 years, you're probably not happy with your results. Even before this very recent drop, SiriusXM's performance has been incredibly unremarkable. But now with this drop, which came because they reported all the subscribers being lost for Pandora and their other platforms, because, again, this narrative for these streaming services hinges on subscriber growth. Well, even now, even if you bought it in the dip in 2020 where you bought it $4.50, even now you're losing compared to that. And you'll also see right now, the stock may look cheap under certain metrics. If you look at the P/E ratio, it's 12.5. That doesn't look terrible. If you look at the dividend yield, it's not huge, which is important to note because it's a stock where some people may think, oh, I'll just buy it for the dividend if it's going to just stay flat. But you're not getting a massive dividend, and it's actually not growing a lot. They recently increased their dividend for the first time in a very, very long time. So then I must ask, what are we doing with SiriusXM? Because debt matters. Debt can cripple a company as much as it can help it if not properly handled. It has a very high interest expense and a very small cash position. They pay about $400 million, if not a little more, in interest every single year because of how much debt they have. So by holding this stock, you're taking a pretty large risk. Their debt position is essentially more than they make in revenue in an entire year. And we're just saying revenue. We're not counting all we're taking away from operations, all we're taking away from taxes, all we're taking away from interest, and then they have much less available to pay off that debt. So it'll take them years and years and years to pay off the chunky debt that they have. Likewise, if they were to go bankrupt, you as a stockholder would not get any money back because the assets would first be sold off to pay whoever they have that debt with, essentially creditors and banks. And then if there's anything left, the stockholder would get that. So that means that with this pile of debt, were you to own SiriusXM and they were to go bankrupt, you wouldn't get anything back. And with that not being paid down, but rather growing, share buybacks and dividends are the only way to get a return. However, if the share buybacks aren't making up for the growing debt, and the dividend's not that large anyways, and the share performance, as we just saw, has been lackluster and will probably not be that remarkable, well, what are we doing here then? And so, no matter if it looks cheap historically, look at what number the discounted cash flow is giving me as a fair value after the debt. So, it's entirely possible that this stock may just stay at this level for a long, long time, just like it did here. Basically, a new set of underperformance or flatlining, but just at a new level. It may go back up. I don't know. I'm not going to predict exactly what the stock is going to do, but I'm just saying, based on this model and based on the growing debt pile, it's looking like a very hard sell to me. And so I say, be mindful of risk reward. Here we have a company that actually has revenue growth. It has healthy net income that isn't necessarily growing hugely, but it's there. Same with free cash flow. It's not necessarily growing massively, but it's also there. It's pretty healthy. But it has a massive pile of debt, and that makes it not necessarily be well priced. So that's where we have to take into account the risk reward first before looking at the potential value of the stock. And this is something that may signal that this stock, rather than being a value stock, is a value trap. So if you have any questions about this valuation, or you have anything to add, maybe you did your own valuation of SiriusXM, or you have different thoughts on it, feel free to comment down below. I'll be very interested in knowing your thoughts. With that said, I thank you so much for watching, and if you like videos like these, make sure to like, comment, and subscribe, because there's going to be plenty more of this. So with that said, I thank you so much for watching, and I hope you have an amazing rest of your day.